On many peer-to-peer platforms, investors can choose from a variety of different loan originators. However, in most cases, it's often not enough to only rely on broad diversification, but to look a bit closer and assess each lender individually. A good example is the current market leader Mintos, where roughly 118 million euros of investor assets are in recovery, which accounts for roughly a quarter of the platform's total outstanding portfolio. So how can investors identify which loan originators truly offer the best chances for stable returns? From my perspective, it's important to take a combination of financial stability, portfolio quality, geopolitical conflicts, and individual country risks into account. These aspects shouldn't be looked at in isolation though, but rather in relation to each other. For example, if a country introduces a new interest rate cap, this can have an immediate impact on a lender's profitability, just as geopolitical conflicts can affect the underlying portfolio quality. Since the financial assessment is one of the most important pillars in my personal lender analysis, I have reviewed a total of 80 different financial reports over the past few weeks. In addition, I have introduced a 5-level rating scale for each metric to make the results easier to judge. Before we take a closer look at the results, a quick disclaimer from my side, as occasional errors in my analysis cannot be completely ruled out. In addition, my rating scale is self-defined and serves only as a guide for better comparability. And lastly, although financial ratios are an important part of the due diligence, looking at them in isolation will not provide a complete picture of a lender's risk profile and hence long-term success or failure. Here's a brief overview of the criteria I use to assess the financial stability. Additional comments and examples for each aspect will now follow moving forward. Unfortunately, not every lender publishes its financial statements. And even if they do, there can be quite significant differences in the reporting standard. An audited report, which was prepared according to internationally recognized standards, such as IFRS, builds trust and reduces the risk that numbers are manipulated or incomplete. Of course, there are always exceptions to the rule, for instance when looking at the EY and Wirecard case. A reputable audit alone is not a guarantee of quality, but it should still be considered as the minimum reporting standard. When looking at the reporting standard, I focused on two main questions. First, who performed the audit, and second, according to which standard was the report prepared. At the top of the hierarchy are the big four firms auditing according to IFRS, followed by smaller but established auditing firms using the same methodology. Those include companies such as BDO or Grant Thornton. Notably was the room for improvement on the Debitum platform, where financial statements have either been unaudited or prepared by unknown local firms with just a handful of employees. In terms of profitability, there is no clear-cut definition either, as also past results were taken into account as well. For example, the Polish lender from Twino received only a mid-level rating despite a profit of 7.3 million euros, as the previous year ended with a loss of 1.2 million euros. Another aspect to consider is the fact that due to time constraints, I have so far only looked at the most recent financial statement for about 80% of the lenders in my rating. This made it difficult to assign the best possible rating, even in cases of impressive profits, if the statement did not include prior year figures or if the report was unaudited. I would therefore recommend to review the last few financial statements independently in case they are available and define your own assessment. Another metric for profitability is the return on total assets. This indicates how efficiently a company has used its total assets to generate profits. For the calculation, I use the average value of total assets from the last 2 financial years. If only the current year's results were available, I left the field blank for the time being in order to allow better comparability between the different values. The equity ratio is an indicator of a company's financial stability and resilience. The higher the number, the better the result. While a minimum of 10% would be a good starting point, I personally prefer to see at least a 20% equity ratio. The debt ratio measures a company's dependency on debt capital. More debt means higher leverage, which in turn exposes a company to more risk and consequently also investors. In this regard, the lenders on Mintos stood out positively as all 36 companies fell into the top 2 categories. The liquidity ratio indicates whether a company's short-term liabilities can be covered by cash and short-term receivables. Across all platforms, there are quite noticeable differences. Unsurprisingly, a lending company like the Credit Star Group tends to rank lower in this area. As for the last factor, I also wanted to take a closer look at the portfolio quality. The impairments ratio indicates the proportion of financed loans in the total portfolio that have already been classified as risky or uncollectible. A low value indicates a good portfolio quality and a cautious risk policy, while a high value means that a larger portion of the loan portfolio is likely to default and will be difficult to recover. Unfortunately, this information is not always available in the financial report, which is why these results appear only a few times in the comparison table. By now, you will hopefully have an idea of how my lender comparison works. Of course, feel free to take a closer look at the results on my blog and use the data to draw your own conclusions. The data will most likely be updated on a monthly or on a quarterly basis to keep the information accurate on the page. Finally, I want to emphasize that a lot of work has gone into this comparison, so I hope the page provides some proper value for the investor community. If it does, then feel free to use one of my affiliate links the next time you sign up on a new platform or treat me with a coffee on buymeacoffee.com. Thanks for watching, have a great weekend, and I'll see you guys again in the next video. So long. Bye bye.